Hello everyone, myself Dr. S. MOHAMED NAZEER. This class I am going to teach you macroeconomics. In macroeconomics, measurement of national income. Now I will explain the circular flow. Production generates income. Income gives rise to demand for goods and services, and demand in turn gives rise to expenditure. Expenditure leads to further production. This is called circular flow. I repeat. Production generates income. Income gives to demand for goods and services, and demand in turn gives to rise in expenditure. Expenditure leads to further production. The flow of production, income and expenditure represents three related phases, namely production, distribution and disposition. Distribution is nothing but income, disposition is nothing but expenditure. They are interlinked in a circular flow. It is shown in the diagram. This diagram shows the circular flow. The production phase leads to production of goods and services in an economy. The income or distribution phase leads to generation of factor income, that is rent, wage, interest, profit. Expenditure or disposition phase relates to spending of income in terms of consumption of goods and services and investment expenditure. This expenditure leads to further production or flow of goods and services. This three process goes on simultaneously. Attempts have been made by various economists to measure the national income in terms of production, value added, that is value added, income and expenditure. Now I am going to explain different methods of measuring national income. National income is a sum of factor income acquiring to the residents of a country from their participation in production activity both within and outside of domestic territories. It is NNPFC, Net National Product at Factor Cost. The circular flow of creation, distribution and spending of income is taking place simultaneously in an economy. That is to say, income is created, then distributed, then spent and then created and so on. I repeat, income is created, then distributed, then spent and then created and so on. Each way of looking of national income suggests a different methods of calculation. In India, Central Statistical Organization measures national income at these 3 points. These three methods of measuring national income are income method, value added or production method, expenditure method. The three methods give three different angles of looking at the income flow based on different types of data. Income method measures relative contributions of factors owner. Value-added method measures the contribution of production units of total output of an economy. Expenditure method measures the relative flow of consumption and investment expenditures. Let's see one by one. Now, income method. What is income method? Income method is a method. National income is measured in terms of payments made to primary factors of production. Income method is also called a factor payment method or distributed share method. According to income method, the components of national income given by the formula. So this is the national income or net national product at factor cost is equals to compensation of employees plus operating surplus, rent, royalty, interest, profit. That is called operating surplus plus mixed income of self-employed plus net factor income from abroad. If we add this 1, 2, 3, 4, we get the national income or net national product at factor cost. Net domestic product at factor cost or domestic factor income is 1, 2, 3. This 1, 2, 3 alone called NDPFC. 1, 2, 3, 4 is called NNPFC. Now I am going to explain steps involved in calculating national income by income method. There are 3 steps. Step 1. Identification and classification of producing enterprises. which employ factor inputs. Step 2. Classification of factor income. Step 3. Estimation of national income. Let's see one by one. Step 1. Identification and classification of producing enterprises which employ factor inputs. Okay, this is the first step in income method. It requires identifying the producing enterprises which employ the factor inputs and classifying the producing enterprises. All producing enterprises can be classified under three heads: primary sector, secondary sector, and tertiary sector. Let's see one by one. The primary sector is that sector which produce goods by exploiting the natural resources like land, water, forest, mines, etc. This sector includes agricultural and allied activities, fishing, mining, and quarrying. This is primary sector. Secondary sector. It is also called manufacturing sector. Secondary sector is also called a manufacturing sector. Enterprises in this sector transform one type of commodity into another type of commodity. Manufacturing sector transform one type of commodity into another type of commodity. For example, leather goods from leather, flour from wheat, sugar from sugarcane, etc. Now, tertiary sector. It is also known as service sector. Tertiary sector is also known as service sector. Enterprises in this sector produce services only. Example, banking, transport, communication, trade, and commerce, etc. This is the step 1. So what is step 1? Step 1 is identifying and classifying the producing enterprises which employ factor inputs. Step 2. Classification of factor income. Okay. Factor income or payment are classified into following groups: compensation of employees, operating surplus, mixed income, net factor income from abroad. Let's see with the help of chart. This chart shows the factor income or payments are classified into the different groups. Okay, this is the first group. Look here. So the first is the components of factor income. So mixed income of the self-employed. So the income of mixed income in terms wages, rent, interest, and profit. Okay. Then net factor income from abroad. What is net factor income from abroad? NFIA. NFIA is equals to factor income from abroad by normal resident minus factor income of non-resident in the domestic territory. We get the net factor income from abroad. And then the compensation of employees. What are the compensations? The wages and the salaries in cash, basic pay, dearness allowances, house rent allowances, overtime allowances, CCA, bonus and commissions, sick leave allowances. Okay, these are called wages and salaries in cash. Number 2, the compensation in kind, free housing, okay, medical facilities, free uniforms, free food, free education, convenience facilities, creatures for children of employees, value of interest forgone on loan to employees. These are called compensation in kind. The next one is the employer's contribution to social security schemes such as provident fund, life insurance, casualty insurance, pension on retirement. Okay, it is different from old age pension, which is transfer payment, pension on retirement. Okay, these are called employers' contributions to social security schemes. And then operating surplus, income from property, rent, interest, royalty. And number 2, the income from entrepreneurship, profit. Okay, so these are all called the components of factor income. Step 3 is the estimation of national income. Okay, and this chart shows how they are related and estimated the national income. See, the first one is the compensation of employees plus operating surplus plus mixed income. So we get the net domestic product at the factor cost or domestic income. If we add net to factor income from abroad, we get net national product at factor cost or national income. That is 1, 2, 3, 4. If you add this 4, we get the national income. Okay, plus depreciation. The gross national product at factor cost or gross national income. If we add the net indirect tax, okay, the gross national product at market price. Okay, we obtained the gross national product at market price. Okay, these are the method of calculating the national income in by income method. Now I'm going to explain the precautions involved in estimating national income by income method. Okay, the precautions involved in estimating the national income. Any income corresponding to which there is no flow of goods and services. Any income corresponding to which there is no flow of goods and services or value added should not be included in the calculation of national income. Okay, there is no flow of goods and services or no value added should not be included in the calculation of national income. Okay, the precautions to be taken by calculating the national income. Or number 1, the transfer payments. Transfer payments should not be included in the national income because transfers are not a productive activity. Examples: scholarship, old age pension, gift, etc. There are unilateral payments. There is no flow of goods and services in an economy with these payments. Okay, with the help of scholarship, old age pension, there is no flow of goods and services. A distinction is made between old age pension and retirement pension. Old age pension is a welfare measure and falls under category of transfer payment. Okay, the retirement pension, on the other hand, is the payment of service rendered by the past. So it is a part of compensation of employees. So the retirement pension should be added in the calculation of national income, and old age pension should not be added in the calculation of national income. So we should not include the transfer payments while calculating the national income. The second one is the illegal income. Income through illegal activities like smuggling, black marketing, theft, gambling, etc. is not included in the national income. Income earned only way of legal activities. Income earned only by way of legal activities should be included while calculating the national income. The third one, income from sale of second-hand goods or capital gains. Income or money received by way of selling second-hand goods or financial assets. For example, old scooter, old house, old radio, bonds, debentures, etc. is not included. Okay, by selling of these goods, not included by calculating the national income. The reason is that the value of their original sale has already been counted in the year of their respective purchase. At present, there is only a change in the ownership of the second-hand goods. The change in the ownership of the second-hand goods. It is important to note that brokerage or commission paid to the broker. Brokerage or commission paid to the broker on the sale of purchase of second-hand goods should be included in the calculation of national income because new factor income is generated. So, in the form of sale of second-hand goods, capital gains should not be included while calculating the national income. Okay, next one is the corporation tax and income tax. Since corporation tax is a part of profit, it should not be separately included in the national income. Instead, profit before deduction of corporation tax, okay, have to be included. Profit is have to be included while calculating the national income. Okay, the corporation tax should not be included in the calculation of national income. It is important to note that compensation of employees includes income tax. Thus, income tax paid by the employees should not be included separately. So, the corporation tax and income tax should not include in the calculation of national income. Now, indirect tax. Indirect tax, that is to say, the tax on production or sale of commodities. Okay, the tax on production or sale of commodities tended to raise the market price of goods and services. Hence, these are included in the national income at the market price. So, indirect tax should be included while calculating the national income. Include free services provided by the owners of factors of production units. Owners work in their own unit but not charge salary. Owners provide finance but do not charge any interest. Owners do production in their own building but do not charge rent. Although they do not charge, yet the services have been performed. The inputted value of these must be included in the national income. Windfall gains. In the national income, windfall gains, for example, income from lotteries is not included. It is a unearned income. Okay, it is a unearned income. Wages and salaries in cash and in kind. As compensation of employees is included in the estimation of national income, any figure on wages and salaries in cash or in kind should not be separately added. Okay. Now, domestic services. Domestic services provide out of love and affection, are not included. I repeat, domestic services provided out of love and affections are not included. But if the same are provided by the paid employed staff such as cooks, gardeners, guards, etc., they will include it in the national income. So these are the things, these are the precautions involved in the estimation of national income by income method. Now I am going to explain value added method or product method or output method of measuring the national income. Concept and measurement of value added. In the computation of national income, value added by different enterprises is included and value of output is not included. I repeat, in the computation of national income, value added by different enterprises is included and the value of output is not included. Thus, it is a crucial difference between these two concepts. Let's see one by one. Value of output. Value of output is estimated at current price prevailing in the market. It is called the value of output at the market price. Value of output can be defined two ways. Value of output of a firm is a market value of goods and services produced by it during an accounting year. It is obtained by multiplying the quantity of output by its market price. So value of output is equals to quantity into price. Value of output in an economy as a whole is the sum total of market value of goods and services produced in an accounting year by all producing enterprises. Value of output is not included in the national income computation. The value of output of firm is the sum total of value of sale of the firm during the year plus the value of change in stock of an accounting year. So value of output is equals to sales plus change in stock. Change in stock is nothing but closing stock minus opening stock. Closing stock minus opening stock is called change in stock. Okay. So value of output is equals to sales plus change in stock. Now value added. Production units produce goods and services. For this purpose, the production units purchase primary factor inputs, land, labor, capital, entrepreneurship, and the secondary factor inputs, raw materials, etc. Value added is then the excess of value of output produced over the value of secondary inputs. So the value added is equals to value of output minus value of secondary inputs, or we can say the value of added is equals to value of output minus value of intermediate consumption. So the value added is equals to value of output minus value of intermediate consumption, or value added is equals to sales plus change in stock. Sales plus change in stock minus intermediate consumption. So domestic product or domestic income, sum total of value added by all producing enterprises within the domestic territory. Okay. Now I'm going to explain the types of value added. There are two types of value added. Okay. Number one, value added at market price value added at a factor cost. Okay, let's see one by one. Value added at market price. Gross value added at market price. The value of goods used for intermediate consumption was not produced but purchased by enterprises from some other enterprises. For instance, a farmer purchased intermediate inputs like seeds, fertilizers from other enterprises. Therefore, to find out the contribution of enterprises to the current flow of goods and services, we have to deduct the value of intermediate consumption from the value of output. By doing so, we get the gross value added at the market price by the enterprise. Gross value added is defined as value of gross output less value of intermediate consumption. So, the gross value added at market price is equals to value of output minus value of intermediate consumption. Now, net value added at market price. An enterprise use raw materials and factors and produce commodities. The value of these commodities is the gross value output at market price. If the value of intermediate output is deducted from the gross value of output at market price, we obtain the gross value added at market price. If the value of consumption of fixed capital, depreciation is deducted from gross value added at market price, we get the net value added at market price. So, net value added at market price is equals to gross value added at market price minus consumption of fixed capital or depreciation. Okay, now I'm going to explain value added at the factor cost. Gross value added at the factor cost. Let's see first this. If net indirect tax are deducted from the gross value added at market price, then the gross value added at the factor cost is obtained. Now, net value added at the factor cost. Now, from the net value added at market price, deduct the net indirect tax, we get the net value added at the factor cost. Now, difference between value of output, value added, and income generated. The point of distinction between value of output and value added is the value of intermediate goods and services. Value of output includes it and value added excludes it. So simple. Okay. Difference between value of output and value added. The point of distinction between value of output and value added is the value of intermediate goods and services. The value of output includes it. Okay. And the value of value added excludes it. Okay, the value of output includes the intermediate goods and services. Value added excludes the value of intermediate goods and services. Okay, now I'm going to explain the measuring of national income by value added method. See, the value added method is defined as the method which measures the national income by estimating the contribution of each producing enterprises to production in the domestic territory of the country in an accounting year. So, national income is equals to sum total of net value added at factor cost across all producing units of an economy. So, national income by value added is equals to gross value added by the primary sector within the domestic territory. Number 2, gross value added by the secondary sector within the domestic territory. The gross value added of the tertiary sector, the domestic territory, minus depreciation, minus net indirect tax, plus net factor income. We can get the national income. Now I'm going to explain steps involved in calculating national income by value added method. The calculation of national income by value added method is done in 3 steps. They are: step 1, identification and classification of producing enterprises. Step 2, estimation of gross value added. Step 3, estimation of national income. Let's see one by one. Step 1, identification and classification of producing enterprises. This is the first step in value added method. As income method, producing enterprises are classified into 3 heads: primary sector, secondary sector, and tertiary sector. Step 2, estimation of gross value added. Value added is the market value of only final goods and services. Value of output is excess of value added over and above the value of intermediate consumption. So the value added, gross value added, GVA is equals to value of output minus intermediate consumption, or the GVA is equals to sales plus change in stock minus intermediate consumption. If intermediate consumption is not subtracted from the value of output, it would be lead to problem of double counting. So we have to subtract the intermediate consumption from the value of output. Then only we get the gross value added. Okay. Now I'm going to explain estimation of national income. This is the step 3. This can be explained with the help of chart. This chart shows the value of the measurement of national income by value added. So number 1, gross value added in primary sector plus gross value added in secondary sector plus gross value added in tertiary sector. We get gross value added market price or GDP market price. Okay, 1 plus 2 plus 3. If we subtract depreciation from GVA, we get the net value added. Okay, NVA at market price or NDP at market price. Again we subtract the net indirect tax. Net indirect tax is nothing but indirect tax minus subsidy. Okay, net indirect tax, we get the net domestic income or net value added to factor cost. Okay, if we add the net factor income from abroad, we get the national income or net national product at factor cost. This is the method of measurement of national income by value added. Now I am going to explain the difficulties involved in calculating national income by value added method. The main difficulty is double counting. A very important error that all statisticians often encounter while calculating the national income by value added method is that of double counting. Since problem of double counting gives exaggerated figures regarding the national income, it should be avoided at any cost. In order to overcome the problem of double counting, the following steps should be taken into account. Number 1, take value added instead of total output. Okay, for this it is necessary to identify the intermediate consumption. So we have to take the value added instead of total output. Number 2, take value of final product only. Take value of final product only. Final products are those which are purchased for consumption and investment. These 2 steps should be taken while calculating the national income by value added. Then only we can avoid the double counting. Okay. Now I am going to explain the precautions involved in calculating the national income by value added method. Okay. The first precaution: the sale and purchase of second hand goods should not be included in national income because it is not a productive activity, but commissions or brokerage paid to facilitate the sale of such second-hand goods is a fresh productive activity and should be included. The commission should be included. The sale and purchase of second-hand goods should not be included while calculating the national income. The value of intermediate good should not be included in the national income. Only the value of final goods should be included. Okay. The value of goods retained for self-consumption should be included. For example, farmer consumes his own produce. So the value of goods retained for self-consumption should be included in the calculation of national income. Imputed value of owner-occupied house should be included. Owner-occupied house should be included. Then, own account production of fixed capital by households, firms, and the government should be included. Domestic services are not included in national income. However, production of services by paid employed person should be included. If you are paying for the services, we have to include that one. Now I am going to explain expenditure method. Okay, what is expenditure method? It is a method which measures the final expenditure on gross domestic product at market price during an accounting year. Okay. According to expenditure method, GDP at market price is the aggregate of all final expenditure in an economy during a year. That is to say, y equals to c plus I plus g plus x minus m, where y is equals to national income, c is equals to private final consumption expenditure, I equals to final investment expenditure or capital formation, g equals to government final consumption expenditure. X minus m equals to net exports. X stands for export, m stands for imports. According to the expenditure method, composition of GDP market price is as follows. Private final consumption expenditure, government final consumption expenditure, government fixed investment, business fixed investment, investment on residential construction, inventory investment or change in stock. That is to say, closing stock minus opening stock, then net exports. So GDP MP by expenditure method is private final consumption expenditure plus government final consumption expenditure plus government fixed investment plus business fixed investment plus investment on residential construction plus inventory investment plus net exports. Okay, this is the meaning of expenditure method of national income. Now I am going to explain the steps involved in calculating national income by expenditure method. The calculation of national income by expenditure method is done in 3 steps. Step 1. Identification of economic units incurring final expenditure. There are 4 categories of economic units which incur final expenditure within the domestic territory of a country. They are household sector, production sector, government sector, rest of the world sector. Step 2. Classification of final expenditure. The final expenditure is classified into the following 3 kinds. The final consumption expenditure, gross domestic capital formation, net exports. The final consumption expenditures, there are 2 types. Private final consumption expenditure, government final consumption expenditure. Gross domestic capital formation has 2 types. Gross domestic fixed investment, inventory investment. The third one is the net export. This classification of final expenditure can be explained with the help of chart. This chart shows the classification of final expenditure or GDP MP. So GDP MP is equals to final consumption expenditure. Look here, the final consumption expenditure plus gross domestic capital formation plus net exports. Look here, the final consumption expenditure is government final expenditure plus private final consumption expenditure. So the gross domestic capital formation is gross domestic fixed capital formation or gross domestic fixed investment. It consists of A. Business fixed investment plus government fixed investment plus investment on residential construction by households. If net domestic fixed capital formation is given, then depreciation would be added to make it gross, plus change in stock. Change in stock is equals to closing stock minus opening stock or inventory investment, and then the net export. So export minus imports. Okay, this is the classification of final expenditure. Step 3. Estimation of national income by expenditure method. So the private final consumption expenditure, okay, plus general government final consumption expenditure plus final consumption expenditure. Okay, add gross domestic capital formation, GDCF, gross domestic capital formation. So GDCF is equals to gross domestic fixed capital formation plus change in stock plus net export. Net export is equals to export minus import. If we add this and all, the gross domestic product at market price, we obtained the GDP at market price 1, 2, 3, 4. Okay, 1, 2, 3, 4. If we add these 4, we get the GDP MP. If we add net factor income from abroad, the gross national product at market price, GNP at market price, we obtained 1, 2, 3, 4, 5. If we subtracted the net indirect tax, we get the gross national product at factor cost. Again, we subtracted the depreciation. Net national factor cost, that is net national product at factor cost, that is national income, we obtained by the expenditure method. Now I'm going to explain the precautions involved in calculating the national income by expenditure method. The precautions to be taken while calculating the national income by expenditure methods are final expenditure. The final expenditure is to be included to avoid double counting. Final expenditure is expenditure on consumption and investment. The intermediate expenditure, like on raw materials, etc., is not included in the calculation of national income. Expenditure on second-hand goods is not included as they have already been included when they were purchased originally. So the second-hand goods purchased expenditure should not include in the calculation of national income. Expenditure on shares and bonds is not included because buying financial asset is not production activity. Buying financial asset is not a production activity because financial assets are neither goods nor services. Gross investment is included in total expenditure. Gross investment includes replacement investment and net investment. Expenditure on transfer payments by the government is excluded in the total expenditure because transfer payment is a payment against which no services are rendered, therefore no production takes place. So the expenditure on transfer payments should not included in the calculating of national income. Self-use of own produced final products should be included in the calculation of national income. Okay, so these are the methods of calculation the national income. The income method, value-added method, expenditure method. Okay.